down 93% off its high. Is Teladoc Health stock a buy? That's the question I'm going to answer in this video, looking at the company's revenue, cash flow, profit margin, valuation, and its prospects over the next couple of years to answer whether or not now is a time to buy this virtual health stock on the dip. So let's get into this analysis. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. I mentioned Teladoc stock is down almost 93%, 92.83% to be precise, off its high. Of course, virtual healthcare was in severely high demand during the earlier stages of the pandemic when people were afraid or hesitant to go into doctors' offices for visits and being around other sick people. Still, I think virtual healthcare has a lot of benefits. I think it's extremely more convenient than going to a doctor's office. And if you're unfortunate enough to be in one of those doctor's offices that likes to overbook as a habit, you can find yourself waiting around, waiting for your appointment, all for just being seen from the doctor for maybe less than 5 minutes, and you spent an hour getting there, checking in, and all that whole thing, right? So virtual healthcare, I think, has huge convenience benefits. Still, it's not really catching on just yet. It's not really exploding the way that it did, of course, during the pandemic when people were hesitant. Let's look at its revenue. 2.58 billion in revenue for Teladoc Health over the last 5 years. You can see that explosive growth during the pandemic, but now the growth has slowed down, and I suspect, and Wall Street also does not expect very robust revenue growth here from Teladoc Health. Well, that's partly because it experienced so much revenue growth during the pandemic that it's going to be difficult for the company to continue with those types of growth rates going forward. Still, longer term, it will benefit from that convenience tailwind. It will benefit from that tailwind as it continues to offer its convenience and attracts both consumers and doctors' offices and doctors' businesses that will benefit from these more convenient health visits. Profitability hasn't been great for Teladoc Health, negative 8.26% in operating profit margin. Not very much progress in terms of this metric from Teladoc Health. Volatility, to be sure, and slower growth from 2022 onwards in terms of making progress towards profitability. Let's look at what Wall Street thinks of its prospects over the next few years. If you look at revenue expectations for Teladoc Health, you have here 2024, 2.77 billion in revenue expected. That's only a slight increase from the 2.61 billion in revenue expected from 2023. And then in 2025, 2.91 billion in revenue expected. For earnings per share, Wall Street expects a slight improvement to $1.23 loss per share from $1.38 loss per share in 2023. In 2025, they expect that to improve to a loss per share of 95 cents, up from a loss per share of $1.23. So improvement, to be sure, on the top and bottom line. It's just not rapid improvement. And when you have a company that's losing this much money on the bottom line, you would like to see better improvement. You'd like to see quicker growth and quicker progress towards profitability. You're not really seeing that just yet for Teladoc Health. Now, this company, I feel this trend is a very long-term trend. It's not going to end in the next 5 years or in the next 10 years, maybe not even in the next 20 years, right? This is going to be a long transition towards more and more percentage of visits being virtual, right? I just had a doctor's visit, a virtual doctor's visit a few weeks ago, and it was so much more convenient. The doctor's visit itself was 10 to 15 minutes long, and having it be virtual was so much more convenient. The local Kaiser that I go to is so inconvenient, rarely ever parking around the area, takes forever to find parking. Then you've got to walk a mile to the specific building that you're going to. Then you got to check in and wait. And Kaiser's pretty good, but still, it takes a really long time for that 10 or 15-minute doctor's visit. I'm taking maybe an hour, hour and a half, sometimes 2 hours out of my day. So to have that visit when it was virtual, 10 or 15 minutes, I was done, in and out quickly. I wish more visits were offered virtually. And so that's the long-term tailwind that I think Teladoc will benefit from. But it's just a slow moving growth market. It's not where the adoption is increasing at a large percentage. It's fewer and fewer and fewer. And the growth rate, as you can see here, is expected to be modest for Teladoc Health. Finally, let's look at valuation. Teladoc Health, after falling 93% off the high, is trading at a forward price to sales ratio of 1.2. This is the cheapest you've been able to buy this stock for, going back all the way until 2020. All the way 2020, you haven't been able to buy this stock at it. So this is the cheapest it's been. And investors have had an opportunity to buy this stock at roughly this valuation for about a year now. It's been flat for about a year after this collapse in share price. It's been flat for about a year, so it's not going up, it's not bouncing back. And so despite the fact that it's trading at its relatively cheaper valuation, like if you compare it to its price to sales of nearly 20 in 2020 and 2021 and 1.2, it's cheaper than before. Still, just on itself, I don't think the stock is cheap at a price to sales of 1.2, given its prospects, given its very slow growth rate expectations, less than double-digit rates of growth expected for the next 2 years, given the losses on the bottom line. All of that being considered, the stock is not cheap. It's not very expensive either. I wouldn't say the stock is really expensive at its current valuation. I would say it's fair. It's fair. It's not too expensive. It's not too cheap, given its prospects, given its forecast, and given the valuation. So if I was to answer, is this a excellent buying opportunity for Teladoc stock? I wouldn't say so. I wouldn't say it's an excellent buying opportunity. I also wouldn't say it's time to sell and get out and cut your losses. I don't think that the company's in that position. I think it's improving modestly, and it has that strong secular tailwind that's pushing it forward, propelling it forward, that huge convenience advantage. So it's one of those where I feel like if you're interested in this stock, it's one that you place on your watch list and you keep an eye out for these opportunities where the stock price falls and you get a chance to get in at a much better valuation, or the company reports better earnings, better prospects over the next couple of years, and all of a sudden, instead of looking at less than double-digit revenue growth expectations, if that revenue growth expectation jumps, or if that earnings progress jumps and it makes more progress towards profitability, and the valuation stays the same, now it looks much more attractive. So it's one of those that I would place on as a hold or place on your watch list and wait for a better opportunity to jump in. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.